Welcome to the Winthrop Wealth 2023 Market Review Network. I'm Andrew Murphy, Co-Chief Investment Officer. The U.S. equity and fixed income markets just finished off a great year, with the S&P 500 increasing by over 26%. This was the fifth best calendar year in the last 20 years. And the bond market ended its two-year losing streak as the U.S. Aggregate Bond Index gained 5.5%. This was especially welcome and something that few saw coming after most asset classes finished decidedly negative in 2022. Today I'll review the factors that drove the markets. I'll go over how the economy, inflation, and Fed policy evolved throughout the year, and then I'll discuss both our short and long-term outlook. At Winthrop Wealth, we follow a total net worth approach, which combines both comprehensive financial planning and investment management. And our investment process is designed to capitalize on the benefits of staying disciplined, opportunistic, and diversified while mitigating fees, taxes, and expenses. From all of us at Winthrop Wealth, we wish you a very happy, healthy, and prosperous new year, and we look forward to speaking with you in 2024. And now, on to the video.
There were two critically important developments that surprised many forecasters and supported the rally in the stock and bond market this year. First, the economy exceeded all expectations. And second, inflation decelerated enough that the Fed is now openly discussing cutting interest rates. Starting with the economy, to the shock of many prognosticators, there was not a recession this year, as the labor market continues to remain strong and support consumer spending. Real GDP growth is estimated at 2.4% in 2023. That's up from a forecast of only 0.3% at the start of the year, and it's estimated at 1.3% in 2024. The other major surprise this year was that inflation is moderated enough to allow the Fed to begin talking about lowering rates in 2024. The Fed has divided inflation into three buckets: goods, where prices are now essentially flat as supply chains have normalized; housing, which is decelerating under rising mortgage rates and just starting to show up in the data; and non-housing related core services, which are still elevated but showing signs of easing. The Fed is turning the page after one of the quickest monetary policy tightening cycles in United States history that saw the federal funds rate increase by over 500 basis points to 5.5% in about a year and a half. The FOMC's most recent summary of economic projections showed that the median participant expects they will cut rates to 4.6% in 2024 and 3.6% in 2025. Fed Chair Powell played the part of Santa Claus this year, as the FOMC's quick pivot from keeping interest rates higher for longer to talking about cutting was a major reason for the market rally over the past several weeks. The S&P 500 increased by 26.3%. This was the fifth best year in the last 20 years. The index is now less than 1% below the all-time closing high, reached on January 3, 2022. While several factors drove the strong returns this year, we will highlight disinflation and its influence on the economy, interest rates, and Fed policy as the main factor. We constantly remind our clients to maintain a long-term viewpoint, as markets can be incredibly volatile over the short term. Market performance over the last several years reinforces our belief in focusing on the long term. After a dismal 2022, very few market forecasters predicted a strong year in 2023. This year saw a substantial reversal at the sector level, with last year's laggards becoming the leaders and vice versa. The three worst performing sectors of 2022 led the way in 2023, including technology, communication services, and consumer discretionary. These three sectors have the benefit of being home to the Magnificent Seven stocks, which were up an average of about 112% this year. And for most of 2023, it seemed like these were the only stocks going up. Although we'll highlight that the market broadened out in the fourth quarter, as over 55% of S&P 500 companies returned over 10%. The 10-year Treasury yield increased for most of the year before peaking in October at over 5%. This was the first time the 10-year has been above 5% since 2007. But over the last few months, yields declined as continued evidence of disinflation led the Fed to discuss cutting interest rates. The decline in yields created a boost for the fixed income markets as bond prices moved inversely to interest rates and credit spreads. Short-term Treasury yields, including the 3, 6, and 12-month, are still around their highest level since the early 2000s. Once the Fed starts cutting the federal funds rate, short-term Treasury yields should also decline. We don't anticipate that these 5% yields will be around much longer, so we are opportunistically enjoying them while they last. If interested, please speak with your advisor about our cash alternative strategy, which is designed for individuals or entities to invest excess cash in a conservative portfolio of short-term treasuries at potentially attractive yields. And please see our recent commentary titled Changing Treasury Yields, 4% is the new 5%. For intermediate-term bonds, the Bloomberg U.S. Aggregate Bond Index, or the AGG, increased by 5.5% in 2023, as the 10-year Treasury yield essentially ended the year where it started. We were pleased to see the bond market in the green after 2 consecutive negative years. These last 2+ years have been frustrating, but we continue to recommend a patient approach. As all else equal, we expect intermediate-term bonds to provide positive returns in the future if yields either stabilize or decline. The strong return over the last few months is a great example of what happens when yields decline. Since October 20th, the 10-year is down by over 1.1%, while the AGG increased by 9.3%. And going forward, intermediate-term bonds are still an attractive investment opportunity in our opinion, as the yield to maturity on the AGG bond index ended the year at 4.5%. We continue to separate our outlook into short and long-term periods. In the short term, the macroeconomic backdrop is brighter now than it was at the beginning of the year. The labor market is still strong, while inflation continues to moderate, and the Fed is now thinking about cutting interest rates within the next several months. But keep in mind that the stock market is a discounting mechanism that looks 6 to 12 months into the future, meaning that the present environment is already reflected in current equity prices. For the stock market to maintain its positive momentum, we will need to see another year of economic, inflation, and earnings data that exceed expectations. So putting it all together, we believe that maintaining a cautious near-term outlook is prudent, as our view is that the fundamentals of the market do not warrant a return to all-time highs yet. In recent years, we have seen the market boom and bust several times, including 2017 into 2018, 2019 to 2020, and 2021 into 2022. We're expecting more muted returns and higher volatility in 2024 as the bill for this year's rally comes due. In our view, investors with a globally diversified portfolio and a long-term horizon should continue to remain optimistic. Markets have historically increased over time, despite frequent drawdowns, as successful corporations have been able to figure out ways to generate profits through advances in innovation and productivity. To capitalize on the power of compounding over long periods, we believe it is necessary to have a comprehensive investment framework focused on staying disciplined, opportunistic, and diversified while striving to mitigate fees, taxes, and expenses. In our opinion, adhering to a structured process and executing on all these components should help keep our clients on track toward pursuing their long-term objectives. Thank you for watching today's video, and please visit our website at winthropwealth.com to view all of our market commentaries.